Investing in the stock market can be a challenging task, but that isn't the case for super investors. There are people who possess a unique blend of financial acumen, strategic thinking, and an uncanny ability to spot hidden gems within the market. Following in the footsteps of these people can help make investing less risky. So it's the first quarter of the year, which means the 13F filing has been released as usual. In this video, we will look at the top 5 stocks that super investors keep buying. Watch until the end, as this will help you make the right decision when it comes to where you spend your money. Starting at number 5, there is Disney, with 8 super investors buying its shares for the quarter. One of the reasons Disney is the top 5 buys among super investors is probably due to the decrease in Disney's stock. Disney stock dropped to a 52-week low of $84 per share toward the end of Q4 of last year. Not only that, the biggest happening at Disney during Q4 was the announcement that former Disney CEO Bob Iger would be returning to the top position after leaving the office in 2020, replacing Bob Chapek. The announcement comes as a relief to investors who have witnessed a turbulent time under the reign of Chapek. Although it wasn't really Chapek's fault, as he had to lead one of the world's largest entertainment industries through a rough time. Nonetheless, Iger is back, and he has on his neck a heavy workload. While it seems Disney has put the bad days behind them, they're still faced with a macroeconomic environment that causes every customer to cut back on luxury spending, which quite unfortunately is every product and service offered by Disney. So in a bid to successfully sail the company through this impending doom, Iger has announced that the company will be reducing its cost outflow by cutting off more than 7,000 jobs. This announcement is an attempt to restore investors' confidence in the company. They also hinted at the possibility of restoring the Disney dividend at some point in 2023. All eyes are now set on Iger's strategies for restructuring Disney for the future, which might include selling off some of Disney's assets to reduce the size of the company. For example, there have been speculations about ESPN being up for sale. This speculation was created with Iger's announcement that Disney's 2 revenue segments, Disney Media Entertainment and Distribution and Disney Parks Experiences and Products, will now become 3 revenue segments, with ESPN forming its own revenue segment. These former revenue segments were formed by Chapek during his tenure, and now Iger has reformed them into 3: Entertainment, ESPN, and Parks, Experiences, and Products. So we can say the significant drop in stock in Q4, Bob Iger returning to reboot the company, and Disney being over its worst days were what enticed these super investors to add the company to their stock portfolios during the last quarter. Coming in at number 4 is Microsoft. Microsoft stock was purchased by 11 super investors in the last quarter. One of the reasons for the super investors' move is the decline in Microsoft share prices. With the current economic crisis affecting the technology industry, the stock price of these tech companies is experiencing a decline, and Microsoft isn't an exception. But this decline in share prices is not the only reason. During the 4th quarter of last year, Microsoft achieved a huge milestone investment-wise with the release of OpenAI's ChatGPT on November 30th, in which Microsoft has a sizable stake. Back in 2019, Microsoft invested $1 billion in the software, and they have recently announced another $10 billion investment in it. The tech company's investment in OpenAI is a strategic partnership of artificial intelligence technologies. Through this investment, Microsoft now has access to some of the most cutting-edge AI research and development capabilities available anywhere in the world. The partnership also enables Microsoft to take advantage of OpenAI's expertise in AI research and development to enhance its own products and services and create new AI-powered products and services that can benefit its customers. ChatGPT has proven to be a powerful and exceptional product, and Microsoft is in a great position to work with OpenAI to increase the popularity of this next big internet technology and monetize it. Besides having influence on AI, which seems to be the next money-making sector in the tech industry, Microsoft is also a great business with many software-based switching modes. Investors couldn't turn a blind eye to its potential, so that's all about Microsoft. The third ranked stock is Meta. Meta was bought by 13 super investors. So why did the super investors make a move on Meta? Well, the stock of the company plummeted and hit a 52-week low of $88 per share in Q4 of last year. It follows that, with the investors buying it in November, they made a good decision, as the stock is at $170 just a few months later. But despite that, the story at Meta is still very much the same. They're currently experiencing a lot of challenges. Mark Zuckerberg is still focused on the AR/VR project, which isn't good for investors right now. A lot of money is being invested into it, but nothing has been achieved as of yet. Meta's losses from Reality Labs reached $3.7 billion in Q3 of last year and increased to $4.3 billion in Q4. Looking at their annual capital expenditures in 2022, total capex hit $32 billion, up from $19.2 billion the year before. But beyond that, the macroeconomic environment also has an impact on Meta. Although they aren't struggling with debt or anything similar, they're currently facing a decrease in their ad revenue. Advertisers are now cutting back on their marketing budgets, which lowers Meta's revenue. Their revenue in 2022 only grew by 4% compared to 2021, and while they observed an 18% year-on-year increase in ad impressions, it fell by 16%. This decrease in ad revenue is due to two factors: fewer advertisers spending less money and the shift in constant consumption towards short-term video, which is much harder for Meta to monetize. So there are a lot of hindrances facing the company. But that obviously isn't a problem for the long-term focused super investors who purchased a lot in Q4. So the second most bought stock by super investors is Amazon. Amazon suffered the most significant crash since 2020. So why? Amazon's business is highly reliant on the willingness of average consumers to spend. For example, when the lockdown began and stimulus checks were being handed out, Amazon experienced a great surge. But when the disposable income decreased due to an inflation spike and cost increases, Amazon didn't fare as well. Meanwhile, due to the rise in consumer demands in 2020 and 2021, Amazon has expanded its business to meet that level of demand. As a result, they went from $16.9 billion in capex in 2019 to over $60 billion last year. But after all this spending, consumer demands drop heavily, which makes things difficult on the retail side of the company. However, one growth driver that is keeping them afloat at the moment is AWS. While their North American and international retail segments both experienced lower operating income in 2022, their AWS sector witnessed 23% growth, indicating that there's still a glimmer of hope for Amazon in this gloomy environment. So the number one stock on the list of super investors most buy is Google. Google also experienced a decline in its stocks in Q4 and hasn't recovered much from it till now. Even though Google is involved in a variety of businesses, advertising still accounts for the majority of their revenue. Like Facebook, they're also experiencing a decrease in advertisers' advertising power. This is evident from the fact that Q4 advertising revenue actually decreased year after year, which is very rare. In other words, revenue didn't increase from the 20 to 30% rate it was before. Meanwhile, the number of workers increased from 156,000 in 2021 to 192,000 by the end of 2022. This shows that it's the same story everywhere. The economic boom of 2020 to 2021 led every company to increase their headcount. But with a shift in the economy that results in less spending by consumers, they're faced with a plight of low revenues, which increases the expenses of these companies since they have expanded their business. All this then led to laying off their workers, but unlike others, Google didn't have any circumstances leading to layoffs. The reason Google isn't in this league is their robust financial status. Google currently has $113 billion worth of cash in short-term marketable securities on their books. While that's $26 billion less than last year, it's still higher compared to their $13 billion in long-term debt and $109 billion in liabilities. And that's a wrap on the top 5 stocks super investors are spending their money on. So what do you make of this video? Let's know that in the comments section. Stay tuned to this channel for more financial updates.